Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures pointing to gains at the open and a new record high for the S&P 500. Second quarter earnings helping lift investor sentiment despite a deepening divide at the Federal Reserve. Fed Governor Christopher Waller laying out his argument for the central bank to lower interest rates, saying it will support a weakening labor market. That take goes against commentary we've heard from many other Fed officials this week and aligns Waller with President Trump when it comes to central bank policy. Plus, the Genius Act heading to President Trump's desk for signature. This is an historic moment for crypto. It's the first piece of legislation on the industry to be passed by Congress. The House also clearing two other bills, including one on market structure, that now head back to the Senate. Optimism over those votes driving the total market cap for crypto above $4 trillion. And sealing the deal after almost 2 years in the making, Chevron finally closing its $53 billion acquisition of Hess. The announcement coming just hours after Chevron won its arbitration battle against ExxonMobil. Let's get a check on stock futures right now. After a record close for both the S&P 500 and the NASDAQ yesterday, we are seeing a little bit of an extension of gains, but it is modest at the moment. All three major averages rising in the neighborhood of 0.1%. That's the gains they're pointing to at the open when you're looking at futures here this morning. Let's turn now to our top stories of the day. Division at the Fed as Governor Waller makes a strong call for a rate cut in July, and Wall Street headed for a winning week after the S&P 500 and NASDAQ closed at fresh records. Plus, President Trump expected to sign that Genius Act today, regulating cryptocurrency. Joining me now, Yahoo Finance senior reporters Josh Schaefer, Ali Canal, and Inez Perret. Josh, let's start with you on this Waller commentary, a speech that he made last night. And as we know, he's been talked about as one of the contenders to replace Jay Powell. Seems like he's making his case here.
Yeah, Julie, I mean, we're certainly aligning with what the president has spoken about in terms of lowering interest rates, right? So Waller highlighting in that speech that he feels like the federal funds rate is currently over 1 percentage point too high. He said the Fed funds rate should probably be around 3%. Currently, it's in a range of 4.25% to 4.5%. So that would be a significant amount of easing from the Fed, of course, calling for that July cut. What I found interesting within Waller's speech is he's pointing out on the inflation front, tariffs are probably a one-time pass-through that you have to look through. And then on the labor market, it's about getting ahead of some potential signs of slowing that we've been following in the labor market, right? So he pointed out private payrolls are basically flat right now if you average them out. And you had data from ADP last month showing that private payrolls, at least per their data, actually declined in June. That was the first decline we had seen in ADP's data going back over the last 2 years. But generally speaking, you look at the chart that's next to me right now, the trend is pretty clear. Hiring momentum is slowing. That was what ADP chief economist Neil Richardson told me after this report. And if hiring is slowing, at some point you wonder how much can things cool before it becomes a problem. So Waller overall saying that if rates are restrictive right now, I want to get out in front of any cooling that we're seeing in the labor market, essentially before it's too late.
Yeah, and we're getting some increasing commentary around the labor market specifically. Ali, we talked to Stephanie Roth of Wolf Research this week, and she talked about the effect that the immigration trends are now having on the employment numbers and maybe masking some of what's going on underneath. And I know you've been looking at some research along those lines as well.
Yeah, Michael Gapin, he's the economist at Morgan Stanley. He has been hot on this immigration story for some time, and tariffs have really dominated the conversation. The inflation part of the Fed's dual mandate, that's certainly been top of mind for FOMC officials as well. But with the immigration crackdown, that could potentially be leading to an artificially low unemployment rate. So that's something to keep an eye on. Josh was just referencing a lot of those ADP private payroll slowdowns that we have been seeing. So it seems like even though we've reached peak uncertainty, there is still a lot of uncertainty within this market. And you can see that division there with all the different Fed officials on what they're choosing to focus on. And I think that was evident in the Fed dot plot as well. We saw a lot of dispersion for that June dot plot, which speaks to the various viewpoints, depending on which side of the mandate you start to prioritize. Now, when it comes to tariffs, I think it's interesting that even Fed Chair Jerome Powell has said before that tariffs should be a one-time price increase. At least that's what the textbook would tell you. But there's just unknowns there. We have the goalpost that keeps moving when it comes to when President Trump is actually going to implement these reciprocal tariffs. We have 50% tariffs on copper, steel, aluminum, and there's a bit of PTSD from the inflation shock that we saw in 2022. That's something Michael Kantrowitz from Piper Sandler talked about, and he's advocating for lower rates. So we're seeing this dispersion among the Fed, dispersion among Wall Street strategists when it comes to those forecasts, and then markets as well are now a little bit more confused. There's now just a 50-50 chance that we could see that rate cut in September. Just a month or so ago, markets were really pricing in that September rate cut, but it seems more and more possible that we might have to wait a little bit longer here.
Yeah, and Josh, even though there is this confusion over the Fed independence, this whole debate, the fact that we have gotten into earnings season, there haven't been any, it's early, but there haven't been any seeming disasters yet. And we keep seeing stocks just sort of incrementally pushing up and up and up to these new records. You are our sort of internal keeper of the forecasts among Wall Street strategists. So what stands out to you?
Yeah, Julie, well, we almost closed above 6,300 yesterday for the S&P 500, right? And really that's just kind of a psychological level that people like us like to look at and sort of make something of. I'm not really saying that it necessarily means much for whether stocks would go higher or lower. But what I do find interesting about that number is that's essentially where the split is among Wall Street strategists. So that's higher than 8 of the 14 strategists that I track, higher than their year-end target. And then you have 6 that are above that. The folks that are above that would be sitting more at a number like 6,600 or 6,700. Those strategists would talk about the earnings that we've been getting and sort of point to the fact that earnings are still looking strong for the index overall. Now you look at the stock reactions though, and that's where a strategist that's sitting at 6,300 would probably point out, or maybe even lower. So Citi Scott Kroner, who has a 6,300 call on the S&P 500 for year end, had pointed to maybe some chop coming within the market and essentially pointing out that with a lot of large rallies in these stocks, a highly valued stock market, are you going to see stocks move significantly off earnings? Netflix, a company that Ali, of course, covers closely, that stock had very impressive earnings last night. I don't think there's a lot you can pick through that report when you raise your full year revenue guidance and you beat top and bottom line, but the stock's down 1% in pre-market trading right now, right? It had already been up 40% this year, had been up significantly, I think 100% over the last year. So you're not seeing some of those names, at least in the early trading. Similar happened with JP Morgan earlier this week. Some of the hottest stocks in the market coming out and saying they're still doing well isn't really moving the needle for investors, at least in this first week of earnings.
Well, and on the flip side, you have something like 3M that came out this morning. That stock is rising, but to your point, it's not a hot stock that moves the market, so to speak. Ali, now that you've had a little time to digest Netflix, any takeaways that you want to share that also might be relevant for sort of the bigger earnings and market conversation?
Well, to Josh's point, it doesn't really surprise me that we're seeing a more muted reaction when it comes to shares. Like he was just saying, the stock is up around 40% since the start of the year. We are trading at 40 times forward earnings. That's about double the S&P 500. And valuation concerns, that was top of mind for Wall Street strategists heading into this earnings season. So for companies like Netflix, some of those other high-flying tech names that have really just soared amid this rally, it's a very high bar to cross. And even though we saw really solid earnings to beat on both the top and bottom lines, that full year guidance raise. We also saw Q3 revenue and earnings coming in ahead of expectations. So that's earnings for the current quarter. It just wasn't enough to do much for the stock here. Now, parsing through that earnings call, it was interesting that they talked about Gen AI, using that in their content. So even Netflix is an AI company, and we've been talking about whether or not these tech stocks are overvalued, whether or not we're potentially in an AI bubble. That's something that Apollo's Torsten Slok suggested. But AI just seems to be the theme of this bull market. And if you take a look back in history, every bull market has that innovation. And this time around, it is AI. And you're seeing those companies that maybe aren't pure play AI companies, but have those artificial intelligence touch points. They're the ones that are performing best here. So just something to keep an eye on. But overall, Netflix has a really strong second half content slate coming up. We have the return of shows like Stranger Things. Wednesday, we just saw the 3rd season of Squid Game debut. That's been doing very well. So we'll see what comes out in the second half of the year, and investors are certainly watching that closely.
And let's get to the crypto piece of this equation as well, because we're talking about sort of momentum generally and what could be more of a momentum trade than crypto. But Inez, it actually has some fundamental news behind it.
Yeah, that's right, Julie. You are looking at crypto assets that have now reached a market cap of $4 trillion for the first time ever. This is very significant for the industry. And this, of course, comes on the heels of the Genius Act passing through the House and now going to the president's desk. And look, moves like this really underpin the entire market because it helps to sort of support the market, the crypto market in general, also giving investors confidence, optimism that crypto is here to stay. And if you take a look at some of the moves that we have seen recently, we saw on Monday, you saw Bitcoin going to all-time highs of 123,000. We've also seen Ethereum gaining more than 22% over the last 5 days. And this is on the heels of that Genius Act, because what analysts are pointing out is Ethereum is a big winner of the Genius Act, which gives a guardrail, so to speak, to the entire stablecoin industry, because stablecoins primarily run on the Ethereum blockchain. So we have seen Ethereum soaring as well. And look, as far as stablecoins are concerned, these are tokens that are backed by the US dollar. This is going to be what analysts on Wall Street are saying, a huge market opportunity, because you are seeing that the stablecoin industry as a whole is going from about more than $250 billion in market cap. Citi is expecting it to rise to about $1.6 trillion by 2030. In a bull case, $3.7 trillion. So this is very significant. And of course, you've had the president that has been supporting all of this. And he's been framing it that, well, this will give the U.S. light years ahead. The U.S. will be light years ahead of places like China, places like Europe, because of these digital assets, which he's saying are the future.
Inez, certainly a situation we're going to keep watching. Josh, Ali, Inez, thank you so much. And speaking about the Fed, by the way, be sure to tune in at 3 p.m. Eastern on Yahoo Finance. Our Jennifer Schonberger will speak with Chicago Federal Reserve President Austin Goolsbee. You don't want to miss that conversation. Officials have cleared the way for Chevron to complete its acquisition of energy company Hess, dismissing rival ExxonMobil's attempt to block the deal. Joining me now with the details, senior markets reporter Inez Ferre. As you and I well know, Inez, this has been a long battle here, and Chevron always seemed pretty confident it would prevail. Turns out they were right.
Yeah, that's right. I think that this took longer than what analysts had expected as far as this arbitration deal is concerned. Look, just to back up for a second, Chevron, in this case, this is all about that Hess acquisition. When they went to acquire Hess, it's a $53 billion acquisition. The biggest part of that acquisition was their Guyana asset, their Guyana reserve, and that was the crown jewel of the deal. Without that, this deal wouldn't really go through. So what ExxonMobil did was they said, look, we have right of first refusal for that asset, because ExxonMobil has a stake in that Guyana asset. And what they were saying, along with another company that's backed by the Chinese, they were saying, look, we have this right. They went into arbitration. And in this case, Chevron won. This is very significant for Chevron because this Guyana reserve produces more than 630,000 barrels a day. It's supposed to more than double by 2027. So this is significant for Chevron because it will diversify Chevron's holdings. And now Exxon will be partnering with Chevron when it comes to Guyana.
Yes, indeed they will. And they came out with a statement as well this morning saying they disagree with the arbitration decision that was made. But they said, we welcome Chevron to the venture. We look forward to continued industry-leading performance and value creation in Guyana for all parties involved. So sort of just accepting what has happened and I guess moving on for all of them, Inez. Thank you so much. Appreciate it. Coming up, we'll catch down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching Talon Energy, 3M, and SLB. First up, Talon Energy is expanding its energy portfolio. The power producer announced it would acquire 2 gas-fired power plants for $3.5 billion. The company says it expects the move will boost free cash flow per share by over 40% in 2026. Talent's acquisitions come at a time when big tech is rapidly building out data centers and searching for the energy to power them. The stock has already more than doubled in the past year, thanks to enthusiasm about its deal to provide nuclear energy to Amazon data centers. Those shares surging 17% this morning. Next, 3M boosting its profit forecast following a strong second quarter as CEO William Brown's turnaround push takes hold. Brown took the helm of the company in May of last year, and he's made a push to sell assets where appropriate for the company. The shares rising 2.5% this morning. He has other things that he has been doing, including changing work practices and focusing on organic sales growth. The maker of Post-it notes and Ace bandages has also made efforts to mitigate tariff costs by adjusting prices and production processes. 3M previously guided tariffs could affect full-year earnings by as much as 40 cents a share. And SLB narrowly beating profit expectations for its second quarter. Adjusted earnings per share falling 4% on an annual basis. Revenue also dropped 6%. Resilient demand in parts of its international business helping offset drilling slowdowns in North America, Mexico, and Saudi Arabia. In an earnings release, the company's CEO said the company remains constructive on the second half of the year, assuming commodity prices remain range-bound. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, earnings season is, of course, underway, representing the first quarter under President Trump's tariff regime. Earnings per share expected to rise 4.8% for the 8th consecutive quarter of year-over-year gains. Revenue expected to rise 4.2% for the 19th consecutive quarter. For more on what investors are watching from these big company earnings, let's bring in Michael Reinking, a NYSE senior market strategist. It's Friday, Mike.
Oh, absolutely. Thanks for having me in.
Yeah, great to have you. So as we look at earnings, right, where is really the focus? Because I'm not going to ask you if companies are going to beat or miss. On balance, they beat. We know this.
Yep.
So where are you focusing your attention as to what's most important?
Yeah. So look, I mean, as you highlighted, right, estimates have been lowered, for the companies to clear at this point. The hard part of the equation is that we've had this 25% rally off of the lows, right? So expectations from that perspective are much higher. Now, I do think we've seen pretty muted responses to very solid numbers, kind of thus far throughout the quarter. I think the bank earnings as a whole were very solid, strong trading numbers, investment banking, kind of with the commentary on a go forward, also very optimistic. Some question around net interest income and margin numbers. But you're seeing this muted response. Now, I think part of that is the fact that this week is also options expiration, so something to keep in mind, right? We've been pinned right around the 6,300 level. And if you think about the use of options in kind of the overall environment, it's increased very significantly, right? So there's a lot of positioning that happens ahead of these events, right? You see some of that reaction function take place in the days following the earnings. I think you have to kind of look 2 or 3 days after to see what the response is. Think of something like GE yesterday. Very solid numbers, raised guidance, stock gapped higher, but ultimately closed lower. Let's see how it actually kind of shakes out in 2 or 3 days.
Mike, you bring up a good point. Is there a way of quantifying the effect or the portion of the market that is accounted for by what's going on with derivatives trading right now?
It's increased multiple times over the last kind of couple of years, right? It's used by not only institutional and kind of the retail investor, right? So it's increased significantly. You can get a sense of what those expected moves are in terms of markets. Kind of when you look at kind of the at the money kind of straddles, things of that nature, to get a sense of what the expected move is. What we've seen is when companies kind of move to that the extremes of those ranges, right, after earnings, one of two things happens. Either you move to the extreme and then you will kind of blow through if positioning is wrong in the derivative side of things, or you kind of move back into kind of mean revert into the range.
I have one more question, sort of down this little digression, and then we'll get off of it. But we were just talking about Talon Energy as one example.
Yes.
Had news. The stock is up 17%. Now, you and I have been doing this a long time. 5 years ago, 17% would be unusual. 10 years ago, it would be really unusual. In other words, individual stock moves have gotten bigger. Is it just
Absolutely.
me? I mean, anecdotally, it feels that way.
Yes.
And is that because of options?
I think part of that is because of options, but I mean, in the case of a Talon Energy, right, this is a very accretive acquisition for them, right? So it helps to diversify, as you kind of pointed out, from nuclear into that natural gas side of things, right? The stock is it has been a leader. This kind of puts kind of some more momentum back.
Right,
into the
sure.
name.
Not to say there aren't fundamental reasons for it to be happening.
Sure.
It's just a very
I agree
big
though.
move.
The moves that you see on a day-to-day basis have especially more recently, right, have gotten pretty extreme, which also suggests, right, that you're kind of getting out, kind of on the risk curve in terms of, where kind of trading is happening.
Okay, so let's zoom out then to the major averages and extrapolate what all this means for them and their ability to keep making these new highs, given all of the things that we're talking about. Do we keep going?
Right. So this week we wrote our quarterly preview and we called it uncomfortably numb, just in terms of the idea that kind of markets have shrugged off all of the negative headlines that have kind of come at us over the last couple of weeks. I think if you look at July, right, there's this well-known kind of seasonality where the front half of July is positive. We've seen that play out again. Things tend to get a little more choppy as you move into kind of the back half of the month and into August. Right, we're also in this period where you're in kind of into the share buyback blackout window, with companies reporting. So, look, I think you can get a little bit choppy, kind of here in the near term, but that pullback I don't think is going to be all that deep, unless there's something kind of that comes out of the blue, or some other headlines that we've heard, from this week. But if you kind of take a step back and look at where things are going, right, there's quite a bit of optimism about earnings. Kind of as you head into next year, you're looking at earnings estimates of up about 12.5%, right? And if you think about kind of this AI trade that's driven markets for the last couple of years, you're going to get to a point, hopefully in the next kind of year, where that begins to transition and you start to see kind of corporate America, seeing some return on that invested capital, right? And you can start to see hopefully a little bit of a productivity boom and helping on the margin side, helping to offset some of the kind of the pressures that companies may face from tariffs.
Mike, good to see you.
Thanks for having me.
Thanks for coming in. Appreciate it. Well, coming up on Yahoo Finance Opening Bid, our executive editor, Brian Sozzi, joining us now. Brian, what's coming up on the show? What do we have to look forward to?
Julie, you have a ton to look forward to. Power-packed show, as always, on Opening Bid. Really want to dive into Netflix. For me, they hit all the buttons on a blowout quarter. Margins up, profits up, sales up, the outlook up, commentary, I would even say that's up. A lot of optimism there. And then, of course, we'll also dive into the quarter out this morning from Amex. I caught up with CEO Stephen Squeri. Asked him why we're seeing a lot of consumer strength, so we'll have more to report there.
Yeah, only one thing that is not blowout for Netflix. The stock reaction this morning, Saz, the shares are down about 2%. I guess people really wanted...
Julie, look, I mean, we previewed this last week on Opening Bid. We suggested this could happen. We're not picking stocks, but we analyze stocks here at Yahoo Finance. Right. So, I mean, just go back and roll the tape.
Okay, I'll do that. Saz, thanks so much. Looking forward to it. That does it for Morning Brief. We got much more ahead on Yahoo Finance, including Opening Bid.